Ever found yourself scratching your head, wondering why some folks seem to effortlessly navigate the complex world of finances, while others can't seem to make heads or tails of it? Why do some people appear to have a magic touch that turns their financial decisions into success stories, while others are constantly battling to keep their financial ship afloat? Is there some secret recipe they're following? Or is it a skill that anyone can learn with a bit of guidance? If these questions have ever kept you up at night, you've come to the right place. Welcome to our channel. Today, we're going to share the perfect guide to managing your money. We're going to unravel the mystery behind financial success and give you the tools you need to take control of your financial future. So if you're new here, make sure you subscribe and hit that bell icon so you don't miss out on our next videos. Let's start by talking about financial literacy. It is a term that has a lot of weight to it. It's like a huge umbrella covering a range of topics from budgeting to investing, from debt management to retirement planning, and more. But what exactly does it mean? At its core, financial literacy is about understanding money, how it works, how it's earned, managed, invested, and saved. It's about knowing how to make financial decisions that will help you now and in the future, and that's what we're going to cover today. Keep in mind that financial literacy is not just about knowledge, but also about skills. It's about being able to apply what you know about money to make informed financial decisions. And these decisions can have a big impact on your life, affecting everything from your lifestyle to your retirement plans. So why is financial literacy important? It's simple. Being financially literate can help you achieve your financial goals, whether that's buying a house, starting a business, or retiring comfortably. And who doesn't want that? But to become financially literate, we first need to understand what money is. So money, it's something we use every day. But have you ever stopped to think about what it really is? Well, it is a tool for exchange. It's a way for us to trade value. In the past, people would barter goods and services directly, but this was complicated. What if you had chickens and needed a pair of shoes, but the shoemaker didn't need chickens? Money solves this problem by providing a universally accepted measure of value. But money isn't just about buying and selling. It's also a way to store value. Imagine if you were paid in chickens. Where would you keep them all? And what happens when you want to save up for something big? Storing your wealth in money, whether that's in the form of coins, notes, or numbers in a bank account, is much more practical. So the concept of money has been around for thousands of years, and understanding its role in society is the first step towards financial literacy. Now, with a better understanding of what money is, let's move on to how we can manage it effectively. Let's talk about income and expenses. Just imagine for a moment that your financial life is a bit like a movie. In this movie, income and expenses are two of the main characters. They're in every scene, and how they interact sets the tone for the whole story. Income is the money that you earn. It's the protagonist of our story. Well, the hero. It can come from various sources. For most people, the primary source of income is, of course, their job. But income can also come from other places. Maybe you have a side hustle selling handmade crafts. Maybe you rent out a property. Or maybe you have investments that generate income. All of these are sources of income, and they all contribute to your financial story. Now let's talk about the other main character in our story. Expenses. Expenses are the money you spend. They're the antagonist of our story, always challenging our hero. Expenses can be anything from rent or mortgage payments, utility bills, groceries, transportation costs, to discretionary spending on things like entertainment, dining out, or travel. Now, understanding your income and expenses is like understanding the main characters in your movie. You need to know what motivates them, what challenges they face, and how they interact with each other. Well, for example, if your income is less than your expenses, you're going to run into trouble. It's like our hero is losing the battle. But if your income is greater than your expenses, then our hero is winning. The key to managing your income and expenses is to keep track of them. This can be as simple as making a list of all your sources of income and all your expenses. Or it can be as complex as creating a detailed budget that categorizes and tracks every dollar you earn and spend. Now, your goal shouldn't be just to understand this, but to use this understanding to make a good decision that helps you reach your financial goals. And that's what financial literacy is all about. Now that we've balanced our income and expenses, what should we do with the money we have left over? Let's talk about saving and investing. Let's say you're on a journey and you've come across a fork in the road. One path is labeled saving, and the other, investing. Now both paths lead to the same destination, financial freedom. But each path offers a different journey. Saving is like taking the safe, well-lit path. It's about setting aside a portion of your income regularly, storing it in a safe place like a bank account. The money you save is easily accessible, and you can use it for short-term goals, like buying a new phone or for emergencies, like unexpected medical bills. And the key to saving is consistency, of course. It's not about how much you save, but about making it a habit. Even small amounts can add up over time. But saving has its limitations. The money you save sits in your account, and over time, due to inflation, it might lose some of its purchasing power. And that's where investing comes in. Investing is like taking the adventurous path. It's about using your money to buy assets like stocks, bonds, or real estate that have the potential to increase in value over time. The goal of investing is to put your money to work, to make it grow. Unlike saving, investing involves a certain level of risk. Yes, the value of your investments can go up, but they can also go down. However, historically, investing has proven to be one of the most effective ways to build wealth over the long term. So should you save or should you invest? The answer is both. Saving provides a safety net, a financial cushion for emergencies and short-term goals. Investing, on the other hand, can help you achieve your long-term financial goals, like buying a home or retiring comfortably. Now we've saved, we've invested, but what about the money we owe? Don't worry, we've got you covered. Up next, we have debt management. Well, debt is not inherently bad. It's a financial tool that, when used correctly, can help you achieve your goals. For example, taking on a mortgage to buy a house or a student loan to fund your education. This is often referred to as good debt because it's an investment in your future. However, debt becomes a problem when it's not managed properly. If you're spending more than you're earning and relying on credit to make up the difference, you could find yourself in a cycle of debt that's hard to break free from. This is often referred to as bad debt. So how do you manage your debt effectively? The first step in managing debt is understanding it. Just make a list of all your debts, including the amount you owe, the interest rate, and the minimum monthly payment. Next, create a budget. Now it's a plan for how you'll spend your money. It can help you figure out how much you can afford to put towards paying off your debt each month. After that, prioritize your debts. Not all debts are created equal. Some, like credit card debt, have high interest rates and can grow quickly if not managed. Others, like a mortgage, have lower interest rates and offer tax benefits. Prioritize paying off high-interest debt first. Don't forget to make regular, or should I say timely, payments. They can help you reduce your debt over time. Try to pay more than the minimum payment if you can, as this will help you pay off your debt faster. And please do not accumulate more debt. When you're working on paying off your existing debt, try to avoid taking on more. This might mean cutting back on expenses or finding ways to increase your income. So debt doesn't have to be scary. With the right management techniques, you can navigate your way out of debt. But what about the future? Let's talk about planning for the future. The first step in planning for the future is to set financial goals. There are some destinations you want to reach on your financial journey. Maybe you want to buy a house, start a business, or retire early. Whatever your goals, it's important to make them specific, measurable, achievable, relevant, and time-bound, or SMART for short. Once you have your goals, the next step is to create a financial plan. This is your roadmap to achieving your goals. It should outline your income, expenses, savings, investments, and any debts you have. Your plan should also include strategies for how you'll increase your income or decrease your expenses, and how much you'll save or invest each month. And keep in mind that financial planning isn't a set-it-and-forget-it kind of thing. It's important to regularly review your plan and adjust it as needed. Your income may increase, your expenses may change, or your goals may evolve. Regular reviews allow you to stay on track and make changes as necessary. Next up, don't forget to create an emergency fund. Think of it as your financial safety net. It's money set aside to cover unexpected expenses or financial emergencies, such as a sudden job loss, major health expenses, or urgent car repairs. Having an emergency fund gives you peace of mind knowing that if life throws a curveball your way, you're financially prepared to handle it. Well, it's recommended to have enough in your emergency fund to cover 3 to 6 months' worth of living expenses. Now let's talk about retirement. I know it may seem far off, but the earlier you start planning for it, the better prepared you'll be. Retirement planning is about setting goals for your retirement, like the age you plan to retire and the lifestyle you want to have, and then making a plan to achieve those goals. This might involve saving a portion of your income in a retirement account, investing in a diversified portfolio, and considering other sources of retirement income. We all know that retirement should be a time to relax and enjoy life, not a time to worry about finances. So if you want that, start planning today for a secure and comfortable retirement. All right, we've covered a lot of ground today. We've explored the world of financial literacy, starting from the basics and diving into the nitty-gritty of understanding money, managing income and expenses, the ins and outs of saving and investing, and the art of managing debt. We've also looked ahead and discussed the importance of planning for the future and retirement. If you enjoyed the info in this video, we'd love to hear from you. What was your biggest takeaway? Do you have any financial tips you'd like to share? Drop a comment below, and make sure you hit that subscribe button and press the bell icon. Thanks for watching.